Welcome back, students, to our Economics of Regulation course. As always, if there are any problems in the stream, just tell me. I will just start with the next lecture. And as always, I will run it at about 125%. So if there are any problems, just tell me. Good morning, students. Welcome back to our Economics of Regulation course. Today, we are going to discuss cost of service regulation and rate of return regulation, which two terms which I largely use synonymous. I will explain in a minute why it's so. Cost of service regulation is, in a sense, the dominant paradigm of regulation in the last century to a large degree, and you will see later on when that changed about in the 80s or something like that. So first of all, let me tell you what the questions are we are going to address today. The question is, of course, we were starting last week or discussing last week, actually it was 2 weeks ago, what a regulator should do if the regulator is omniscient, knows everything about demand, about cost. And then it's rather straightforward, because then a regulator can just determine what the optimal pricing scheme is, like Ramsey prices, or whether to charge peak load prices and so on. That's rather straightforward. But in the real world, of course, the regulator is typically much less informed about the environment. That is, in particular, regulator typically does not know the exact costs the firm incurs, and it also typically is much less informed about the demand the regulated company faces. So the question, or the starting point, is what should the regulator do if it doesn't know cost? Of course, the traditional approach is that she or he must find out. We will look into a little bit of the detail later on, how that works, what the regulators do, and so on. But anyway, we know that the regulator faces limited information. And the particular problem is, what are the capital costs? Because suppose this company employs some equity, some Eigenkapital in German, then the question is, what is the allowed rate of return? Should, as a former CEO of Deutsche Bank said, the rate of return be 25%? Should it be close to the safe rate you currently earn? Should it be 0%, or should it be even negative, or should it be 9.29? It was in the first regulatory period in German of the incentive regulation. So this is an important question, and we are going to address that. And this is because this allowed rate of return is so important. It is also why this kind of regulation is called rate of return regulation, because a capital typically makes up of a large degree of the total cost of these network industries. Of course, once you know that you earn a certain rate of return, that you have a certain allowed rate of return, you might, as a company, want to act strategically, knowing that you can currently earn, say, 6-point-something%, and you could, in an alternative use, earn much less. You might have an incentive to act strategically and overinvest. And that's the second part of today's lecture, where we are going to look into the so-called Averch-Johnson Model, a model these two authors set up or published in, I think, 1962 in American Economic Review. So the question of this chapter is, how are these problems dealt with by the regulators traditionally? And that's what we are going to do. So cost of service regulation. What does this mean? In German, it would be Kostenzuschlagsregulierung, and rate of return regulation is called Rentabilitätsregulierung or Renditenregulierung. So our starting point is that the regulator has limited information. The firm is much better and informed and may act strategically. And so pretty much I already introduced these terms, cost of service regulation and rate of return regulation. And as I told you, it was somehow like the benchmark that was used widely in the 20th century to regulate companies. For instance, in the German water industry, many municipal water companies which are owned by the municipalities are still subject to some kind of cost of service regulation. It also partially holds for airports and so on. Okay, so how does that look like in practice? And if you look into the notes I also publish with your PDF files, you see I have many information about the German regulation here. Typically what you have is a uniform system of accounts, and you have standardized cost reporting rules. And what I want to show you right now is just an Excel sheet from the Bundesnetzagentur, the Federal Network Agency, which you see here, which is called Erhebungsbogen für Elektrizitätsverteilernetzbetreiber. So this is just the form German municipal electricity distribution network operators have to fill in. And what you see here is, first of all, of course, they have to fill in these their names and so on. But what we have then is, hopefully you can see that better than I can do at the moment here, is that they have The profit and loss statement we also have to set up, and we have to fill this in according to these rules you see here, okay? And they also have another tab here. I don't know how well that is visible on where you have to set up the balance sheet, which you will hardly see. But what you see up here, there is a very long name of this file. I just downloaded it yesterday or the day before yesterday from the Beschlusskammer 8, BK8, BK8, which is just the chamber of the Federal Network Agency, the Bundesnetzagentur. And there you have to put, if you're a company, put all your important information into that. That's what we would call something like a uniform and standardized rule of accounting, okay? So, and what we also have in this respect, but we will get back to that later, you might have some yardstick regulation possibilities. That is, you compare one company with other companies, or in terms of EU regulation, you compare the cost of one telecom operator with the in one country with the cost of a telecom operator in another country. And in terms of these costs, of course, cost of service regulation pretty much means just, okay, you report your cost to the regulator. You are a regulated company. You report this cost to a regulator. The regulator approves them, and then you're allowed to charge a price so that you get a revenue which covers your cost. Okay, but the point is that typically or very often there might be costs where it's not clear that they are reasonable. And the regulator will typically check whether these costs are reasonable. We will discuss that later on. There's also the discussion whether the respective efforts are really used or investments are really used and useful. But we will get back to that later on. And another point here is that this cost of service regulation typically faces some regulatory lag because prices are not adjusted continuously. So you don't have, if you see there's a cost increase next week, you will not get refunded from next week on, but there's typically some lag. And only after some period, which also has some incentive effects, because if you are able to reduce your cost today and the next cost monitoring takes place only in 2 years, you will have additional profits in the meantime. Okay, in Germany, for instance, the period of incentive regulation has a 5-year lag, or it takes 5 years. Yeah, the second thing is, how does then regulatory practice look like? So in the US, it's pretty much what is called a rate case with 2 phases. In the first phase, you determine the revenue requirement or the total cost of service. I think in the next slides, we will just discuss in much more detail what this means. And then in a second stage, you set the rates, the tariffs, and so on, okay, like Ramsey prices and so on. In Germany, and here I want to go again to German practice and just refer you to the webpage of the Federal Network Agency, if I'm able to find that right here. I hope that it's visible right now. This is just from, as you see here in the link Bundesnetzagentur.de, Beschlusskammer, it's BK08, it's Beschlusskammer 8. Okay, the 8th chamber, they decide on Erlösobergrenzen, which would be revenue cap regulation and revenue regulation. And they have a very nice description of what this means and what regulation is about at all. And the important thing I want to highlight here is what the task of these Beschlusskammer 8 are. And this is what is written here. So they really what they do in the first place is Kostenprüfung. Okay, they really check whether what the costs of these companies are, and then they determine these revenue requirements, the revenue cap. And we are doing that in a sense every 5 years, because they set regulatory periods for almost 5 years. Okay, that's what they are doing, and so it provides a lot of information here, the Bundesnetzagentur. So I recommend to you that you once in a while look into these homepages. Websites. Okay. Yeah, getting back here. Okay, just a small comment. I gave you the link to this Bundesnetzagentur page here. Unfortunately, you don't see the whole part due to the, I don't know, the picture is slightly different if once I use here a web page, or once I stream a web page rather than I stream the PowerPoint, but should not be a problem. If there are any problems, just tell me and ask. So, but the important point here, what you see here in terms of the Bundesnetzagentur, in this document, you have EOG, just meaning Erlösobergrenzen. So if you go to the Bundesnetzagentur's homepage, so the Federal Network Agency's homepage, just enter the search term Erlösobergrenze, and then you will find these documents. To my slides. So what is cost of service? What are the components of these costs of service? First of all, important are, of course, the operating costs, also called OPEX. We cover fuel, like if you have if you run a power plant, of course, you might need gas or you might need coal and so on. A labor input, of course, you might have other materials, etc. These would be the operating costs, and actually that's what you have to fill in the Excel sheet I just showed you. Okay, and then the other important part of your costs, the other important cost component would be capital cost. Okay, and these capital costs, they define the rental, or the problem is here, what is the rental price of this capital? So we will discuss that in a little bit later time. The point is, you start with some value of your asset base. So just think of a electricity transmission operator. They have all these cables, they have all these transmission lines, of course, and they made some investment, and that's a value of their regulatory asset base. I think in the next Tuesday, I will just show you a slide again from the Bundesnetzagentur, where they set up, or where they describe what the current status, or what the current value of the assets of various electricity transmission companies is. Okay. I just want to show you that right now. Phil will show you that on Tuesday in the assignment. But here you see what they currently estimate, or actually what the Bundesnetzagentur estimates in terms of how the current capital stock changes over time. So here we have the capital cost, and here you see what really the value of this asset base is. Okay, and here you see how that works. Just here, this is already the capital cost, not the capital stock, but you see this, and we will get back to that. You see how that changes. So it will become clearer in a few minutes once we get back to this discussion here in the slides. So you start with the value of your asset base. This is just, say, 10 billion or something like that. Of course, if you have assets, they typically depreciate over time. Even these cables or these masts, they depreciate over time, and you have to replace them after, say, 20, 30, 40 or 50 years. And then, of course, in order to determine what your yearly costs are, and that's actually what is the important thing, you have invested 10 billion and some time ago, okay, in the past, say, 15 years. And the question is, what are your yearly costs then? Given that you have this asset base, then of course it's important, if you have the 10 billion, what is the allowed rate of return? If this is your own investment, if it's equity, so is the allowed rate of return 5%, then 10 billion would be 500 million or something like that, which are then your cost of the equity. And of course, what is also important, you have to pay taxes on that, and you have to cover that as well. We will go into detail. I will give you much more information on that. And there are other costs like property taxes, franchise fees, and so on. In Germany, for instance, operator of distribution, electricity distribution systems, like Stadtwerke Gießen, they have to pay a so-called Konzessionsabgabe, which is like a franchise fee. They have to pay that to the municipality. Okay, anything else? This would then be the total, this would be our cost components, and this would be the total cost of the service. And this is also called the revenue requirement in year T. So how much do you need in revenue in order to cover these costs we put up here, okay? And here's just in slightly formal terms here. So the total revenue you need. So this would be your Erlösobergrenze. Okay, that's what we just saw on the homepage of the Bundesnetzagentur. This would in a sense be Erlösobergrenze. It's made up of the operating cost, of the depreciation, of your allowed rate of return, or of your capital cost in a sense, plus some other franchise cost or Konzessionsabgaben and so on. And what you see on the next slide is that this is really something which is used in practice. I gave you an example here from Australia, because they typically document very well their regulatory proceedings. And here you see Sydney's water prices for the period of 2016 to 2020, how they are determined. And here you see how the regulator proceeds. And you see it starts with setting up or calculating the total revenue requirement. And the very important first ingredient is this asset base. Okay, the value of the regulatory assets. So you start with some asset base in year, say 2015. You make some capex. This is some capital expenditure, some investments. You also face depreciation. We will get back in more detail what is that, but I briefly explained it anyway already. And then you get what you have at the end of the year. I don't know which year I use, but at the end of the year you get then the closing regulatory asset base. Okay, so this is what you have in terms of asset, and then you use what is called, and what we will introduce also or discuss in a minute, the so-called weighted average cost of capital, which then determines your capital cost, because it gives you the return on capital you are allowed to earn then, and applying that to your asset base, you get now what you have in terms of capital cost here. This would be then your capital cost, where of course the asset lives which determine depreciation also matter. Then you have your OPEX, your operating costs, which are subject to typically to efficiency reviews. So do your workers really work efficiently and so on? Do you have the right number of maintenance personnel, etc.? And this then would give the total revenue requirement. And this is pretty much identical to what we have here set up in terms of our simple equation here. Okay, that's what they are doing. And here you see some numbers to this problem. So once you have done this, you come up with what is called here an annual revenue requirement up here. And you see it's made up of OPEX, operating expenditures, like core assets would again be personnel and some materials and so on. And then with water, of course, the purchase of water seems to be very important in Australia, which is also an important part. So this would be almost 2 billion Austrian dollars. And you see OPEX is about 50% of all costs. And then a third of the cost is the return on assets. And then you have, so this would be cost of capital really, and then you have depreciation, and then you have some other things. And in the end you come up with a necessary or a revenue requirement, annual revenue requirement of almost 10 billion Austrian dollar. Okay, that you see how that works. So it's pretty much, and it's actually pretty straightforward, and it's also related to what in Germany is done in terms of the regulation of, say, electricity and gas markets, where we have something which is slightly different, which is called an incentive regulation. I think I have to use my pen again. I'm used to highlight it like this. And it has different components, but these cost of service, at least the determination of what the cost of service are, is a very important ingredient of this incentive regulation. Incentive regulation also features some cap. It's a revenue cap here. We will discuss that later on once we discuss price cap, but it has several components of this cost of service regulation, and that's what you see here. The cost components matter a lot, and the Bundesnetzagentur, the Federal Network Agency, I think this slide is anyway due to Frau Gröbel, a member of Bundesnetzagentur. And so they use different cost components. They decide among them about according to whether they are what they call controllable or non-controllable. Non-controllable would, and they have two parts. Non-controllable, of course, would be cost. It would also be this Konzessionsabgabe with franchise fee. And non-controllable cost, the strange thing is, I think there was a huge discussion whether kindergarten is a controllable cost, where you have a Betriebskindergarten, that you run your own kindergarten, and I think it's non-controllable. And of course, you have many other controllable cost components, and there we have certain other instruments like this efficiency comparison here. That is, they just, if you think in terms of German distribution network operators, there are about 800 of them in Germany, because many municipalities run their own electricity distribution, local distribution network. And then they compare them. So this would be yardstick competition or benchmarking, and we will discuss that a little bit later. Apart from this, in a sense, these cost components, apart from the A, which would be then the efficiency component, which is related to benchmarking. So this is more like the traditional part of cost of service regulation. But then you would also have the more modern parts, which are dating from price cap regulation, like here the inflation rate, which would be or would be known from the price cap regulation with the RPI, the retail price index, which is nothing else than the the inflation rate, and the productivity factor would nothing be than the factor X we are going to discuss later. So here, this is already a preview to a part when we discuss more like price cap regulation and not only cost of service regulation. But the important point is here that it also features component of these cost of service regulation, and it has certain other elements like the quality element and so on. We don't discuss it here. Okay, Okay, a brief break here, and I just want to ask for questions in Webex. Yeah, back again, no problems, no questions, so we just can move on here. Rate of return regulation. So the important point here, what is the value of the capital stock? So that's what I already told you. This is the first thing. What is the value of the capital stock? It's not so clear, because how do you value firms' assets? The invested capital, and how do you determine depreciation rates? You will see, is it the original value? Is it the value if you want to buy it again? I think it's called reproduction value. So I already forgot how this term is in English, and I just can't find it. So Wiederbeschaffungswert, would that be in German? Okay, and finally, how to determine the allowed rate of return on investments. That's what we are going to look into right now. So the basic problem here, and that's very important, this is all taken here from the handbook article of Josco, and what he really states is that the basic problem is that the firm has to make investments, huge investments in long-lived capital, okay? So like setting up an electricity distribution or transmission network, having to invest, say, 10 or 20 or 15 billion, and the consumers have to pay back that over time, okay, over their economic lifetimes. And I think such a long distance electricity transmission line will have an economic life of 20, 30 or 40 years. And that's a problem. So a stock, the value of the capital investment, must be transformed into a flow, a stream of cash flows or rental charges over the lifetime of the assets, okay? And that's the problem you really face. And that's also from Josco here. The basic principle, the basic legal principle for price regulation in the US is that the regulated prices must be set at levels that gives a regulated firm a reasonable opportunity to recover these costs, okay? And what is also important, however, not all costs, but it has to make efficient investments. And so it has to meet its service obligations, and but it should not overinvest in a sense. So here you have to make investments so that you can really provide electricity to all your household customers and to your business customers, but not overinvest in a sense. And now it's much easier if we take that in slightly mathematical terms. And the point here would be, so here the case zero is just the investment necessary. And if you know that exactly, if you determine that exactly, then you know you have in, say, n years, some cash flow, some income or some profit stream, and the discounted value of these profit streams, here discounting with the interest rate R, should be just at least as high as investment. So this is just what is stated here. The present discounted value of the future cash flows should be at least equal to the cost of these capital facilities, these investments, which are financed by equity, by debt, by preferred stock, Vorzugsaktien, and so on. And here, what I state, what I already told you, R is the firm's risk-adjusted cost of capital. We will get back to that. And pi t is the cash flow in year t, which is just revenues minus operating costs minus these other expenses. And here, the case zero would be the reasonable cost of an asset. So what is a rental price of capital? The problem is, first of all, you have infinitely many streams of cash flow which yield these present discounted values. So you might have a profit of zero the first 10 years, but very high profit later on. You might have a very high profit in the first 10 years and then no profits in the following years and so on. And so infinitely many cash flow streams. The question is, which one do you want to have? And the problem, the profile of this stream does not matter if there is no competition and the firm is free to choose the necessary prices. But the problem is, suppose you build some electricity power plant, and you were expecting that there was no competition, and at some point in time, competition was introduced, and electricity prices fell, and then you might have what is called stranded assets. So we will get back into that. That competition might lead to a problem, like say Deutsche Bahn. So you expect certain returns on your capital, and then it turns out once all of a sudden that there's Flixbus, and your income stream, your profit stream go down. Now, the question is, what is the appropriate profile of the cash flow stream, and how do we value that? So, and what we are using is the economic principles to value the assets as they were or as they would work in a competitive market. And as you hopefully remember from oh, actually, I could just jump back to this slide of the Bundesnetzagentur. Here, what you see is they want to do, or we want to set prices so as if there were competition. Okay, that's how they want to do that. Okay, so they look into the costs and so on and check what the prices are. And I just don't find it here, but they should have an appropriate rate of return on that, and typically they should have prices or profits according to what it would occur in a competitive market. And of course, what we also have to take into account is there is inflation, there is technical progress, and there is depreciation. So now this goes back to, I think, a paper by Short-Tirol, and is also highlighted in Short-Tirol's and Jean-Jacques Laffont's book on telecom regulation. And here, what the economic principles would say about the rental price of capital here. So what we start with is some investment. We make an investment in a machine, which machine produces a homogeneous product, okay, like say electricity. And this machine depreciates. And here life is simple because it depreciates physically at a certain rate D. What does it mean? If this machine turns out, say, 10 million units today and the depreciation rate is 10%, it will only turn out 9 million units next year. Okay, it would be 10%. The number of units of output declines at a rate D. So in terms of our electricity, it turns out, say, 10 gigawatt today and only 9 gigawatt hours, 10 gigawatt hours today and only 9 gigawatt hours next year. And the operating costs are 0 here assumed for simplicity. And the important point is some further notation. If you have a new machine, the competitive rental value for this new machine would be this value V. So that's what you would have to pay if you want to rent it, and because that's exactly what it produces in terms of value. And we assume some discount rate. That's like with your this competitive rental value is like with your leasing car. Okay, for a certain time you have to pay a certain amount. Okay, so now we have to do some strange things because we have to introduce some notation so that we finally can derive this nice expression here, which relates the price of this machine to the present discounted value, that is to the income stream this machine is going to produce. And therefore we need to know what will be the rental machine of a machine you bought in say year 2000, T would be 2000, and what is the value in S 2020. And now you see you just have the stream of a value, or what is the value in today. Now, here you see what a new machine would manage to produce today, but your old machine already bought 20 years ago does no longer produce this 10 million units, but it produces much less, namely the D is just our 10% over the 20 years, and this E, this exponential, this Euler number, is just a standard kind of depreciation in continuous time. Okay, it just tells you what is the rental value of an old or what is the value of an old machine today. And so if you think in terms of your leasing car, you have a leasing car which is now 5 years old. What is the value today? And now you know if that car, if that were new, it would have a value for this year of say, what is a monthly, what is a yearly rate? I don't know. Suppose that the monthly rental would be 1,000 of a new car, but now this car is 5 years old. You have some depreciation. It would be only 600. That's just how it works. Okay, but then we can, of course, we also always have to know from the viewpoint when I buy this machine, what would be the income stream in the coming years. And so what we have to do is, starting in year T, what would I earn in year S? And that's just what I do here. Here is what you see. This is what your machine is value in the machine you buy in 2020 in 2000. What will it will be value in valued in 2020, and you have to just discount that back to the year 2000 in order to know what is then. And this is just discounting back. You produce the present value by discounting with the R going or using this continuous time discounting. S minus t, this would again be just our 20 years. Probably it would have been better if we started with year t equal to 2020 and then setting S 2030. So because then we could invest right now, but it should be clear. Okay, and so here the left-hand side is what we just derived, and the right-hand side just rearranges that. That's exactly what we do. It just here, if you look into that, it just puts together the terms with the t's in the exponent and with the s's in the or here with the r, and here with the d, here with the t, and here the s. Okay, apart from that, exactly the same thing. Okay, but then what is, that's just what we need here. Then what is a competitive market price for this new machine? So we buy that machine and it costs 10 million, and we buy that, now suppose this is year 2020, and we know from year 2020 on, we will get an income stream VS. Okay, this income stream changes over time. This rental value changes over time. First of all, because we have, perhaps I better use the highlighting here. First of all, because we have depreciation. You know, the machine in 5 years will just produce fewer units. And second of all, in 5 years, it will be worth less because you have discounting. Okay, so hopefully this is somehow clear. This is a complicated expression, a complicated term. And what we are interested is, of course, now we make this, say, 10 million or something like that investment. Okay, how should we repay that, or how would that be repaid in a sense in a competitive market? What would be the resulting income stream in a competitive market? That's the important question here. And that's what we are going to look into. That's actually what is done on the next slide. But I want to jump back here in order to illustrate that. Okay, you buy that today, and given that we are in continuous time, what you are looking into is just derivatives. How would that change over time? And that's actually what you also have to do in just a problem we will discuss in the next assignment. Okay, so if we take the time derivative, we know actually that's what where we calculate what the next V is, what will be the rental value in the next period. So if we take a time derivative here, of course, we get on the right-hand side just dp dt, the time derivative of the price. How does that change? And if we take the derivative with respect to t, just get rid of this PdV. We only are interested here in this part. If we take the time derivative here, you see we have two components. We have two components here. The first of all is just here this part with the discounting, and the second is this integral here. And of course, we apply product rule. We just take the derivative with respect to t of the first part, which just gives or puts down r plus d, and we are left with the remaining part. The remaining part is just pt. So this is the first part, plus then we have to take the derivative with respect to t. And so if you take the derivative of an integral with one of the integral boundary, if it's the lower, it's just what you have in the integral, the vs, or exactly value vt, and of course with a minus. And of course, if s is equal to t, we will just be left with that. And that's exactly, that's what I should have put it on this side, but that's exactly what is written here. dp dt was the derivative of the right-hand side, and then I told you take the derivative of the first term, the e minus r plus dt, and you get the r plus d down, and times the p and minus the v. And what if you see here, we lost, of course, if we take the derivative with respect to highlight it again here, to this t, okay, you get then a t up here instead, of course, because you evaluate it at t, but you see here, you have here e raised to the power of minus r plus d t, and here you have just 1 over this, so this just cancels out. And that's how you obtain the derivative on the next side, okay? So hopefully should be straightforward. Yeah, but now we are getting into a very interesting result, because now we get our VT, our per period payment we should give to our company in order to repay for our capital investment P. Okay, that's our per period payment. And now you see this makes a lot of sense what we have here, because suppose it's 10 million. You have an interest rate of R, say 5%, and a depreciation of 5% as well, then it would be you would just have to repay 10% of your capital investment. Okay. However, there is another part, and this should be straightforward. This is this dp dt. So the price of your capital investment also changes over time. And how does that change? Okay, suppose if you buy a computer today, what is the computer worth next year? Now the point is, the worth of this computer changes a lot because you have a lot of technical progress. A computer you buy this year will be rather outdated compared to next year's machines. That's why the value gets down. And so what you have here is the price of this new machine changes over time. And the first effect is this exogenous change due to technological progress, and the other is general inflation. Okay, general inflation should be rather clear. If general inflation is 5%, the price of this machine will increase, and you will next year have a higher value of machine, because abstracting from depreciation, because you have the inflation, a new machine will be more expensive. At the same time, if you have a positive rate of technical change, your machine will get outdated. And that's what we have here. So our dp dt is nothing else than this I minus delta pt, where I is the interest rate, excuse me, not the interest rate, of course, but the inflation rate, that's what we defined here, minus the rate of technological progress. So if your inflation rate is 5% and the rate of technological progress is 3%, the price of your machine will go up by 2%. If the inflation rate is 0, but you are talking about computer and the rate of technological progress is, say, 25%, your computer which you bought today at 1,000 euro will be worth only 750 euro, or you will be able to resell that at 750 euro next year. Okay, should be clear. We have, and I could show you that. I think I just jumped there. We have a respective question. If I'm able to find it on my computer, you have these time path where you will have to calculate the time path of annual revenues if the firm is regulator and the regulator sets all variables according to the situation of perfect competition. That's where you are going to, with the 10 million and so on, where you're going to solve that. Okay, hopefully this is clear somehow. We will discuss that later on, but the important point is, and that's a nice thing about that, you get a very intuitive and plausible result on how to repay your investment. And here you see the P is the P here is in your investment, and how do you pay back it each year? There you have, in a sense, the interest rate and what is called the economic depreciation. Okay, interest rate plus economic depreciation, which is made of physical depreciation, but also the depreciation due to inflation, which would appreciate it, and technological progress. Okay, and so very easy if you have here investment of 10 million, and you have an interest rate of 5%, a depreciation rate also 5%, inflation rate of 2%, and now I have to rate of technical progress also of 2%, you will have just 10% of these investment be refunded, in a sense, in the first period. Okay, this would be the basic formula for setting both the level and the time profile of the capital cost. Okay. Okay, this was hard stuff, and I just want to ask for questions in Webex right now. Okay, we move on here with our discussion of these expressions here with the PDV. Okay, hopefully it's somehow clear what I try to explain to you. We will discuss that later on in the tutorial class. I think. But where you also will just apply it and you see it's rather straightforward, we will also look into the whole time path of what this looks like. But the important point is that even though you start up with a very complicated kind of argument where you derive this present discounted value, you see that the result is really a rather intuitive one. Hopefully, that's also your impression. Okay. Now, here you see we have a wonderful way to really come up with a way to transfer this stock into a flow. Okay. The problem is, of course, that you need to know a lot. So here we have this simple, at least Götz calls it a simple economic approach. It requires a lot on terms of the regulator. The regulator, for instance, has to know the rate of technological progress, which is rather hard. Inflation will be not so hard. Remember, and I just want to jump back here, the rate of technological progress also enters the German regulators' incentive formula here with this productivity factor. Actually, they use something which is determined by the Sachverständigenrat, the German Council of Economic Advisors. But the problem is they typically have a general productivity index, not specific to, say, electricity distribution system operator, but one for the general sector. So it's rather complicated to come up with an appropriate measure of technological progress. Furthermore, it assumes perfect competition and the absence of lumpiness of investments here. So you also can just you can research. I just move on here. Does not allow for sunk cost and asset specificity. That's a complicated word. Asset specificity. Actually, I think it's a word due to Oliver Williamson, a Nobel laureate, doing a lot of work on transaction costs. He just recently passed away, I think last week at the age of 90 something. So, okay, now getting back to our sunk cost, what is the problem here? Now, it assumes that you have something like a resale market here for your investment, okay? So if it turns out after 5 years that you no longer need your trains or something like that, you just can resell them. Or if you no longer need your cables because there is no longer a wind power plant, you just somehow resell it. But the point is, of course, to a large degree, the investment cost will be sunk. Actually, I wrote something on that together with my former colleague Gerhard Clemens. You find the link to this paper in the notes to the slide. I did that in a regulatory proceedings which involved rate setting by the Austrian telecoms regulator, and I was working there on behalf of Telekom Austria, where we stressed this point that it's just not so easy. If you have some legacy network, you might really have something like stranded assets. They are no longer usable for some reason. Because you have a change in regulation, you have a change in technology, and so on. That's what we have here. Stranded cost, there is large uncertainty about the future path of demand and technology. So you have an option value. Just to ask you a question, would you invest in an operator of a gas transmission network? Actually, there's a very large one, the former E.ON Ruhrgas. They are now called Open Grid Europe. Okay? And Open Grid Europe, they manage these pipeline networks where you get, I think currently there's a lot of talk about Nord Stream 1 and 2, where a pipeline network where we get gas from Russia delivered by Gazprom. And now the question is, would you right now invest? There are investments necessary at several billion euros in order to connect all these pipelines and so on. Would you invest in that? Now the problem is, what do they deliver in these pipeline networks? They deliver natural gas. What is natural gas? Natural gas is a fossil fuel. How long will we have fossil fuels? Actually, we want to abandon fossil fuels. So maybe that in 5 years or in 10 years, politics or politicians say no more fossil fuel. So Fridays for Future dominates, gets into the parliaments and so on, or we get a green chancellor and no more fossil fuels. So, and that would then lead to a demand uncertainty, no more demand. And you already have stranded cost. You invested this 10 billion, but now no one wants to have to natural gas. Of course, the hope of these gas pipeline operators is that we get hydrogen or that we get these what is called green gas instead of these natural gas. But this was just to highlight the large uncertainty about the future path. Okay, and now actually I think the depreciation time or period of such a gas pipeline network is some 50 years or something like that. Okay, but nevertheless, what I just showed you is a dominant paradigm in EU regulation. So here you see what a good kind of forecaster I was, talking about Green Chancellor and so on last year. And perhaps some of you, I don't know whether any one of you participated in last semester's seminar on our way or the requirements in terms of competition policy and regulatory framework in order to get to a climate neutral Europe in 2050 or something like that. And we had actually Mr. Suri as a speaker, and he's member of Open Grid Europe, and he talked about this way to this green economy, about hydrogen and so on. So we might talk more about that if you like in Webex in a few minutes. In particular in telecoms regulation, where you have this LRIC, which we have been discussing previously, okay, long-run incremental cost. And it's based on this kind of argument here, and it's also related to the kosteneffizienten Leistungsbereitstellung we also have been discussing. And now we are here, and finally I get my translation of Wiederherstellungskosten. It would be reproduction costs. So what are your capital costs actually? Or what is your investment cost? This is original cost, what you paid when you invested in the first time. Say 25 years ago, you built up your electricity transmission lines. Or is it the reproduction cost, or is it some fair value, however you define it? And how do you depreciate over time? Do you, so of course in our problem, previously we had in our model, it was just some physical depreciation which was given exogenously. But would you decrease linearly, or how else? I think somewhere I should have explained this Brandeis formula. The problem is here, how should your price path look like? Okay, how should your price path look like? Why is that a problem? Now I want to jump to finally show you a diagram. Here, the price path. Here you have time, okay? And here you have, in a sense, your V somehow. What should you pay? And if you have some initial investment, now it gets complicated not to you invested 10 billion, okay? And so in your V, suppose it's just 10%, so it's 1 billion. But you know you have depreciation over time. So you have depreciation over time. Suppose it depreciates in 10 years. So after the value will go down to something, and after a certain amount of time, you again have to invest. Then you incur, and of course this investment is 10 billion or worth in the first year, only 9 in the second, 8 in the third, and so on. And you pay, actually it would be more like something non-linear, and we will describe that in more detail or look into that in the assignment class. But the point is if you have just according to this depreciation rule, to this percentage depreciation rule, the value of your network goes down, and so would go down your yearly investments, okay, or your yearly payments by customers. And you, of course, with an electricity network, you do not continuously reinvest, because you only build new masts every, say, I don't know, 25, 30 years. And so but the value goes down over time due to depreciation, and you would pay less. And then what you incur after, say, 10 or 15 years is a rate shock, because then you have the reinvestment and the value goes up again. And so you would get these Sägezaun Muster, which I also should know what it's in English, but I forgot it somehow. Okay, so I think it's sawtooth. And what I want to show you here right now is really the diagram I just showed you, because here you see exactly this way down, okay, how this rate base depreciates, and therefore the yearly payments, which would be the Erlösobergrenze, so your revenue requirement, would go down. And you see here, this is based on the capital cost based on investments up to 2006. And the problem here, of course, is this is based on these given investments, and of course you will have had investments also in 2016 or 2026 or in 2020, and that would mean that at that time your capital base, your asset base will jump up again, and then you go down again, and that's exactly what I tried to highlight in this diagram. Okay. So hopefully this has become clear. I think this is based on something I did in the tutorial class last year, and I think Phil will do that again, or also on probably next Tuesday. So the problem is here, how should this price path look like? Would you rather want then, I just could jump back here, would it then perhaps be better to pay a little bit less in a very beginning, but then have something like a flat line, which of course should then have the same or should lead to the same kind of present discount? Yeah, after we learned how our capital should be evaluated somehow, our capital stock, and what the time path should be of our payments, we have to turn to what kind of rate should we allow, rate of return. And hopefully, or many of you will have taken finance courses, and from that, the term weighted average cost of capital should be familiar to you. This is just a weighted average cost of the interest on debt, on equity, and other finance instruments like preferred stock. And equity would then be valued in terms of the opportunity cost of capital. Of course, you always take tax treatments into account, etc. Okay, that's what you get. And so what the firm has is some capital structure. Okay, it uses different financing instruments like debt. Here, what we assume is that 50% of the operations, or of the capital of the investments is financed by debt. Then they use another instrument like preferred stock, Vorzugsaktien, which would be 10% here, and 40% is equity. Okay. Now, what is easy, of course, you can just look at what is the rate that they get money from their banks, or whether if they have any bonds outstanding, what the coupon of these bonds is. Okay, similar perhaps with preferred stock, but very complicated with equity. So what is the real rate, or what is the cost of equity? And that's the problem for the regulator, how to determine that. Once it has it determined, then it's rather straightforward, because we have the firm's weighted average cost of capital, which just is really this weighted average cost of capital, where you have here the 50% of these 8% here, you have the 10% of the 6%, and then here the 40% of the allowed rate of return on equity. So this is the opportunity cost of capital. And those of you who did find a finance course hopefully have run across the CAPM, the so-called capital asset pricing model, where you can determine the so-called beta, which is just, or gives you the company-specific risk, and therefore allows you to determine the risk-adjusted rate of return. Okay, that's what you do, and that's what actually just does the Bundesnetzagentur. I think, I don't know whether I have it here in the notes. In Germany, the Bundesnetzagentur hired Professor Stehle to just I'm just stopping here, because the Gutachten is called, the report is called Gutachten zur Ermittlung des kalkulatorischen Zinssatzes. So this is just an expert report on how to determine these cost of capital. Okay, and where you have some finance professor typically who does that. And hopefully, I think I once had a student who also did that. It's rather straightforward. You can do that in Excel. You have these standard kind of arguments, and you can just collect it. If you want to have another example, I think I related to some frontier study where you see how they calculated this CAPM. Okay, so that's rather interesting and rather important. And here you see what the outcome might be. Actually, that's for the second regulatory period in German electricity. regulation. The first was from 2009 to 2013. This was for the second regulatory period starting 2014, and now we are at the third, which started 2019, I think, in electricity. And here is how this is determined. First of all, that was determined in 2011. We determined the risk-free rate of return. This is typically some Bund bonds, some of the federal government, some bonds. It was rather high at that time. And then you have the important point, which is determined by the beta. This is the so-called risk premium. It was determined at 3.59, and so you get a return after taxes, and you also take then into account corporation taxes, and corporation taxes in German would be Körperschaftssteuer, or here this trade tax would be so-called Gewerbesteuer. And the most important part here is this 9.05. This was the rate of return in the second regulatory period. In the first regulatory period, I think it was 9.29. Right now in the third, it's 6.91 because, of course, the risk-free rate went down a lot. Okay, this is allowed rate of return in Germany. It's called for Neuanlagen. That is for new investments. Okay, that's what you're allowed to earn. That's how your capital costs are determined. And you see, you get the impression that this is rather high. And what is interesting, for instance, if you go back here to this slide, in Germany you have a provision, given that your debt level might be rather low. Of course, if you want to have to produce a higher weighted average cost of capital, or which is here, you just and if your debt is only 2 or 3% in the situation right now, you could increase your WACC, your allowed rate of return, in a sense, by increasing your equity share from 40 to say 60%, because then your WACC would increase. However, there is a provision in regulation that the maximum amount of equity you can use is 40%. And by the way, actually, that's what is also stated in our Excel file. If I manage to jump to that, you previously saw that, and in our Excel file, our companies also have to. There are so many kalkulatorisches Eigenkapital. There are so many tabs here, and here you see, if you can see it, Eigenkapitalquote. Okay, here is what you have to put in terms where you have to put what is your share of equity, what is your share of debt. Okay, that's what you also have to put down here. Okay, so we are almost done right now with this part, because this was pretty much what we had in terms of how cost of service regulation and rate of return regulation works. What we saw is the problem is how to translate stock and investment or a capital stock, which is necessary to run your network, because you first have to set up your network. This typically requires a huge investment, and how to translate that into a flow so that consumers pay that back over time. Because of course you don't want to pay back a 10 billion investment which has a depreciation time of 50 years just within 1 year. Okay, and so you saw here how we can think about that, how this income or how we can translate this stock into a flow. This was our V. And then, of course, the second important part was then what is the allowed rate of return. And here is what you learn. Actually, that's where you can use your finance course and determine the CAPM, the risk-adjusted rate of return, and then really determine this allowed rate of return. And then, of course, remember, and I don't know whether I managed to jump back to the appropriate slide, the first part here. Yes, in US regulatory practice, you have these two phases in such a rate case. You have the determination of the revenue requirement or the total cost of service. That was our first part, where we determined the cost. How do we calculate them, and how do we monitor them, in particular as a regulator, and then how do we translate that into a flow. And then in the second stage, we have to determine the rate we want to set. And this rate might then be something like Ramsey prices and so on. Typically, it's not very sophisticated with many regulators. Typically, these statutes just tell you that you should not discriminate. and you would have some flexibility. Historically, rates are set really due to political economy considerations. This is along rates here. In telephone, rates were usually set very low for local rates and very high for long distance rate, particularly affecting business customers. These times are long gone, but it was just not according to cost, but according to political economy considerations. It's always also so that prices in rural areas were set low compared to the cost of serving these customers and so on. And of course, given that you have a lot of joint cost here, so you cannot directly assign it, it provides you a lot of rooms of headway to just assign or allocate that rather arbitrarily. Oh, and you can justify almost any, and that's really interesting what Josko states here, you can justify almost any tariff structure. And nonlinear prices, I mentioned that previously, they have been used, for instance, or common in telecoms and also in electricity. You pay a fixed monthly fee and then a per unit charge. In France, I mentioned Boiteux, Marcel Boiteux to you. Ramsey-Boiteux pricing has been used. In the US, much less. In Germany, I gave you this example of the setting of railway access track charges, where we use something like Ramsey prices right now. Okay, but that's something we discussed before. What is interesting, for instance, in Germany, we have some discussion on the water companies, where were some cartel cases, antitrust cases, where companies were taken to court by the Bundeskartellamt or even fined because they abused their dominant position and charged too high prices. But then that led to the so-called Rekommunalisierung, that is, the companies which are just subsidiaries of municipalities are not subject to antitrust law, and they have then to set Gebühren, fees. And however, the interesting thing about these fees is that they cannot discriminate among consumers. Everyone has to pay the same, irrespective of say, the amount of demand. And here you run into trouble as a municipal water company. If you have a large company buying water from you, you cannot charge them the same kind of price than from your residential customers. But anyway, in Germany, you also have typically politically determined tariff structures. Yeah, that's about, in a sense, the empirics and also the principles underlying these cost of service regulation. But hopefully you got some idea about these 9% or the 6.9% we have in German electricity regulation. What does this mean? Now, if you... Okay, time for another break here, and I just move on to Webex. Okay, we proceed with the Averch-Johnson model right now. We have in German electricity regulation. What does this mean? Now, if you just invest in German electricity networks, you have, in a sense, allowed, or you might also call a guaranteed rate of return of 6.91%. Does 6.91% look good? Actually, currently, what you earn in some alternative investments, if you buy bonds from the German government, you earn nothing. Okay, so even though, of course, regulated companies also stress the problems they have because of the high risk, of the high regulatory risk, on face value, the 6.9% look very good. You might want to invest because it might be better than an alternative. And actually, that was the impression Averch-Johnson had already in 1962 and published that. And what was their problem? If you have a rate of return regulation and you have a rather high rate of return, which is higher than your cost of equity, okay, suppose you somehow get funds somewhere for 4% and you can earn 6.91%, and that sounds like a pretty good deal. And what you might want to do is just invest. You just want to build networks because you know, irrespective of whether you use them or not, whether you need them or not, you can earn a lot of return on them. And that's actually the basic idea behind the Averch-Johnson model. So you might have strategic behavior by the monopolist. And I just want to highlight that by showing you the Averch-Johnson model right now. So what you start is a profit maximizing monopoly, some standard kind of production function. Q is a function of capital and labor, some inverse demand function. P is a function of Q, and firm investing capital. And it has some opportunity cost of capital R, which is the return it has to pay really to their investors in a sense. And the price of capital is normalized to 1. It doesn't have any effect here, and we assume for simplicity no depreciation, and we have labor input which get wage paid, W paid. And now, so now what we are doing is just looking into what cost minimization would require here. So what the regulated firm wants to do, it wants to maximize its profits, and these are monopoly profits here. This would be the standard problem here. This D is nothing else than P, so the first term, oh, you can't read that, but this is nothing else than a price. So the first expression is just the revenue, and the WL plus RK is just the cost. And so what we can do is we can rewrite it in terms of K and L, capital and labor input, and so just set or put the revenue as a function of these input factors, because this just simplifies here the expression we have here anyway, where we just substituted a production function for the outputs. Yeah, and so this is an easy way to write it. And what we are doing now is just we know that this company is not a standard monopoly, an unregulated monopoly, but it faces regulation, and the regulator has only one instrument to determine the behavior of the regulated company, and that's it's setting the allowed rate of return on capital. Okay, and you will see that this affects the prices the firm can charge, because it affects the investment, and of course, if you know the inputs here from the production function, you immediately get the output, and if you get the output, you also get the price, and if you get the price, you get a profit. Okay, and we assume that the regulator has no specific cost function. We just want to look into the case the regulator sets some S, and what does that mean about the behavior of the regulated company. And of course, this S must be higher than the real cost of equity, because if it were lower, the firm would not produce. Of course, it will be not higher than the monopoly rate of return, because then the firm would just not want to have it or would not act according to it. And the point is, it's a very strong assumption about the regulator here. Averch-Johnson make, they assume that the regulator has no other information about the firm than its cost of capital, or and the firm's production, also the firm's production function and so on is unknown. Okay, and given we have that, we just can set up the optimization problem of our regulated company. And our regulated company faces a constraint. And now, so what is the constraint? You see here, this is revenue minus cost minus the allowed rate of return. Perhaps it's easier to put it like this here. It's RKL minus WL has to be smaller or equal than S times K, because the left-hand side is now nothing else than, in a sense, operating profit. And operating profit is what goes then to the capital owners to the capital owners as a profit. And given you have a K, this operating profit must not allow you a rate of return higher than S. Here it's just put different. So it sets here. It sets here then, using what we define in the previous on a previous page as pi, it sets a maximum on the profit pi, and it's really determined here by this different S minus R times K. That's just if you substitute or if you substitute the pi from what we had here into, if you substitute that into the constraint. Okay, you just expand it by plus R. Plus RK and minus RK, then you get this thing. And here you already see a point here. Given you have a certain difference between S and R, how can you increase your profit? By increasing the K. Okay, of course there is a limit, because if you produce too much, prices will go down too much. But what you see here is you can increase your K and thereby increasing your profit. Okay, yeah, now standard optimization problem subject to some constraint, and that's what we are doing. That's what we did in some assignment when we calculated the cost minimization problem for, say, a Cobb-Douglas function. And what we see here, standard problem, and what we are doing, we are maximizing profit by choosing K, the optimal level of capital, L, the optimal level of labor, and the Lagrange multiplier. And the first order condition are standard, so we just take the derivative with respect to K here, get RK, where RK is nothing else. If we take the derivative of R with respect to K, we first have to take the derivative of the revenue with respect to the output, because we know if we increase K via the production function, we get a higher output, which is nothing else here like the marginal df/dk is nothing else than like the marginal product of capital times, okay, if an increase in K leads to an increase in output of 1 unit, we know what is the marginal revenue of that unit. Okay, that's what we get. And apart from that, it's straightforward, minus R minus lambda RK from the constraint here minus the S. And this is equal to 0. We are doing the same for L and lambda. Lambda, of course, yields only the just the constraint. And here, what is interesting here in terms of labor input, we get a standard result that, in a sense, this would be something like the value marginal product if that were a competitive firm is equal to the factor price. This is standard. However, here is what you see is different, and now we are just playing around with these two conditions and showing that we don't get the same condition as under perfect competition, okay, or as we would get with profit maximization. And that's what we are doing on the next page, just playing around with these two conditions, and it's rather straightforward here. First of all, second order condition, this has to be 0, and the second order condition means just that if you take the further derivative, it has to be negative. And if you do that, you know that RK will be, the RKK, the second derivative with respect to K of the revenue, will have to be negative. Otherwise, we don't get an optimum or a maximum. And this, because here you can rearrange that to get a 1 minus lambda times 1, or you probably cannot read it, times RK. And from that, from the second order condition here, you see that you will get lambda in this range of 0 and 1. This is important in one of the next lines here. Okay, now from the first order condition, here's just the rearrangement. Remember, for RL it was just W, but with the RK you also have the lambdas here. That's what you get from this condition here, hopefully, if you just rearrange it and solve for R. Okay? And now the important point is the rate of technical substitution here. Under cost minimization, it would be just R times W, and the ratio of the marginal products is just equal to the ratio of factor prices. But here we have an addition. So again, you see, I always make little errors here. I write R over W, but I tell you R times W. So hopefully this doesn't distract or confuse you too much. But should be clear, okay? Of the marginal products is just equal to the ratio of factor prices. But here we have an additional term, okay? And what does that additional term mean? Now here it's important that lambda is smaller than 1, so this is positive, this is also positive, this is also positive. The whole expression here, this one is positive. Therefore, it's negative, so it's your ratio of the marginal products with the marginal product of capital in the numerator is smaller than the interest rate wage ratio. And what does that mean? First of all, this expression would be the expression for cost minimization. So we don't get cost minimization, and what we see here is that it's smaller. How do we get a smaller value on the left-hand side? If the right-hand side is smaller, we just increase capital because we have diminishing marginal products. So you will see that in assignment. We will have an assignment where you just calculate that. So we have diminishing marginal product, and what you do as a company in order to satisfy this condition, you increase K. And what does that mean? The regulated monopoly does not minimize cost. Input proportions are distorted, and you have a capital using bias of the rate of return regulation. The regulated company uses too much capital. That's pretty much what the Averch-Johnson model says. Okay, and here's some evaluation here. Here the firm does not waste inputs. All inputs are hired or used. It's different from what we discussed earlier on of X inefficiency, like the Leibenstein inefficiency, because everything is used here. But of course you overinvest. You have what is called gold-plated networks. you overinvest in your capital because you have this high allowed rate of return. You might think, why just not set it equal to R? Because that really would increase the distortion. We will show you that, because then, of course, it has to also always to be strictly above. And then the only way to really get higher profit would be to have a very, very high capital level. And even though you could calculate an optimal S, that doesn't make sense because it requires information. If you had that information, it would be better to set the right prices anyway in the first instance. Okay. Regulatory lag we will discuss later on, because if you have a regulatory lag, if you know you have 5 years until the next cost review or something like that, you might not want to overinvest because that reduces your profit. What is Paul Josko's evaluation of this Averch-Johnson model? Perhaps first of all, I tell you that I think the Bundesnetzagentur considers this an important problem. And always is wary of overinvestment, and we have all these investment budgets. If you want to invest as a transmission line, transmission system operator, you always have to go to the Bundesnetzagentur and apply or submit your proposal of this investment. What Josko says, and I'm finished in say 2 minutes here. What Josko says is that this Averch-Johnson model really highlighted that this regulatory mechanism could create incentives for the regulated firms to produce inefficiently and then overinvest. Okay, here. And the point is here, of course, there are shortcomings because it's an extremely simple model with an extreme asymmetry, a bit of information between a regulated firm and the regulator. The regulator doesn't know anything about the cost. And in real world, it's different, but still, it's hard for the regulator to find out whether an investment is really necessary and whether the extent of the investment is optimal. And here, what he states, what I already told you, is that there is a difference between what the model assumes concerning the behavior of the regulator and what regulators actually do. You could also introduce dynamics into that model, but this just doesn't lead to much. Empirical tests have not been particularly successful. Josko says he also did some, and he doesn't find so much overinvestment. There's, however, I think some indication that there is overinvestment to a certain degree. The question is whether overinvestment is always a bad thing. That's what you see in the Corona crisis. So we are happy that we have some well-working infrastructure right now. And the other point was that the kind of inefficiency observers typically have in mind when they consider network industries or companies is a different one. This would be this X inefficiency. I already told you that, and we will get back to that once we discuss moral hazard and so on. However, in the notes, I gave you a link or a reference to a paper by Darren Acemoglu and Amy Finkelstein published in the Journal of Political Economy about input use in the healthcare sector. And what they show there is that once in the healthcare sector regulation changed so that you got not reimbursed your standard cost for labor and so on, but you got, in a sense, a allowed rate of return on capital. What these hospitals did, they just invested in new health equipment, okay, made high investments. And in a sense, what they found out is that here you get something like an Averch-Johnson effect. Okay, I think I'm done with this part right now. I apologize for taking a bit more time, but hopefully it worked. I thank you again for your participation, and I'm available now for some questions on Webex, and hopefully we can discuss that and any further question also in a tutorial class. See you again next week. Thank you. Okay, so we are almost done. Actually, I just want to show you another title or another paper, which hopefully shows up right now here. Oh, it doesn't. Take just a second here. That's what you should have here. So this is just a recent paper by Steve Cicala, or however it's pronounced, published in American Economic Review some 5 years ago. And in the current issue, there is even a comment and a reply on that paper. What this paper does, it looks into US electricity generation, which was at some time regulated. And what he really looks into in detail is this, what we call the Averch-Johnson effect. And he shows really that the introduction of regulation led to overinvestment in a certain sense. Okay, That's about it. I'm available for further discussion in Webex right now, and otherwise, see you next week. Goodbye.